evening, McCormick and Company and Lockheed Martin. Events like this simply wouldn't be possible without them, and similar support at other events is most critical for us, and we certainly are deeply indebted. And McCormick and Lockheed Martin are two bulwarks supporting what the Council does. It's a grand act of public service in which they engage, in my view. Let me remind you of our next two upcoming events. Pierre Vimont, Ambassador of France to the United States, will join us 2 weeks from tonight at the World Trade Center. And after that, we'll be joined by Professor Lampton of Johns Hopkins School of Advanced International Studies. The ambassador is going to speak on the global challenges in the global economy, a French point of view. The address by Professor Lampton will be U.S.-China relations in the Obama era. But our topic tonight is focused upon economics, as you know. For decades, we looked primarily at national security. There's no question that matters of the economy are at the forefront of our concerns in international affairs today. As you all know, a few months ago, we had Professor Richard Cooper of Harvard talk on the subject of the international economy. The French ambassador will address it. And we asked Mr. Forbes to join us because of his renown as a student of economics and a commentator of huge respect, who's received innumerable rewards for his work, is read by many. Forbes has 900,000 subscribers apparently, a terrific number. And Forbes, when you include their international publications, is close to 5 million. So it certainly is an enterprise which reaches widely, and Mr. Forbes is known not only for that wide reach of his enterprise, but also for the comments which he makes on his own. His facts and comments section of Forbes is read assiduously by many. It's widely respected, and the other thing that catches one's eye, I think, are his writings. And a number of you had a chance to purchase a couple of the books tonight. I've always thought that the question of ambition, power, and glory, especially when you compare the ancients to the moderns, is a fascinating thing to do and leads one inevitably into a philosophic understanding of the practical matters about which one speaks and the way in which recurrent themes of behavior are lodged in contemporary figures as well as in the ancient past. And so the study of history, as reviewers have said very nicely about Mr. Forbes' work, is most helpful in that regard. And our topic tonight, as you all know, is Whither, the economy, Whither, Entrepreneurial Capitalism. And his book, which several of you bought tonight, says that capitalism is the answer to that question. It's a fascinating theme. It'll be undertaken by a man who all of you know from his public life, which has been extensive, but whose reflections are at least as interesting. It's my great pleasure to present to you Mr. Steve Forbes.
Well, thank you very much, Frank, for those very kind words. Thank all of you for coming here tonight, and especially thank you, those of you who bought the book. Won't quite make up for the depleted 401k, but hey, everything helps. And also I'm very grateful that after the remarks tonight, I get a free dinner. Not quite the same as a free lunch, but during these times, you take what you can. But as Frank indicated, I'm going to make some remarks about the economy, and I'm appreciative of the Council of having me here, because if you look at the last century or so, there is a very strong correlation between the strength of the United States economy and the well-being of the global economy. We tend to think of foreign policy and economics as different spheres. No, they are absolutely intimately related. In the 1920s, for example, an extraordinarily prosperous decade, a very innovative decade, still underappreciated by many historians, the United States did take an active role in the world. Even though history looks back as an isolationist period, it actually really wasn't isolationist. I'm not just talking about Mexico and Central America, but the U.S. took an active role in the Washington Disarmament Conference, obviously in the early 20s. It also was involved in the Dawes Plan, which helped get Germany's finances back on its feet after the reparations and disastrous inflation of the early 20s. And we were involved in the Young Plan in the late 1920s, 1930, to once again deal with German reparations before all of it was blown up by the Depression. So in the 1930s, when the Depression came, the U.S. did really shrink into isolationism, passed the Neutrality Acts, and tried to pretend that the world just wasn't there. And if you look at the Depression itself, the blunt truth is that if it had not been for the Great Depression, the Nazis never would have reached power in Germany. In 1928, the Nazi vote in Germany was about 2.5%. When the Depression hit in 1929, 1930, within 3 years, the Nazis became the largest party in Germany and were the largest when Hitler became chancellor and, of course, then took dictatorial powers shortly thereafter. So economics has consequences, not just in terms of pocketbooks and well-being, but also the political consequences are profound. In the 1970s, a dreadful decade economically in this country and certainly for the West, rampant inflation, ever higher bouts of unemployment. By the early 1980s, the unemployment rate in the United States was higher than it is today. And the 1970s were, again, a dreadful decade in terms of foreign policy. The U.S. was seen as a nation in decline. We had huge setbacks in Central America, Africa, not to mention adverse events, to put it mildly, in Iran, and then the Soviet invasion of Afghanistan. So these things do go together. The 1980s saw a very great resurgence in the United States, and in 1989, as we all know, the Berlin Wall fell, the Cold War ended, and Eastern and Central Europe achieved freedom. So these things do go together. And today the question is, will the United States be pulling back from the world? A case can be made, whether it's the missile defense system, what is happening on trade, which is very ominous, not trade particular decisions like the tire decision with the Chinese, or the failure of Congress to approve free trade agreements with Panama, Colombia, and South Korea, but the fact that so far this government has not made any major free trade initiatives. In the past administrations, it might have made tactical decisions to help a particular industry to buy short-term political support, but the overall thrust was very much in favor of free trade. And we all know that the economy today is in trouble. But first, before discussing the economy, its impact here, why it happened, and its impact around the world, I think we need to put things in perspective. First of all, economic cycles are not inevitable. They are a result of policy errors or policies done right. After World War II, for example, we did go into an era of free trade, first with GATT and then the WTO, the World Trade Organization. We put in a monetary system to prevent the beggar-thy-neighbor policies of the 1930s, the Bretton Woods International Monetary System. We had the Marshall Plan. We had a strong overseas defense program, i.e. NATO in 1949. And it worked. Europe and Japan made a vigorous recovery from the rubble of World War II, far faster than the experts could have predicted, and we had a boom time in the 50s and 60s. So in terms of where we're at today, put it in perspective. We don't have to have a long period of unemployment. We don't have to have a long period of subpar economic growth. Between the early 1980s and 2007, we and the world went through one of the most extraordinary periods in human history. Never before in a 25-year period, never before had so many people in so many parts of the world advanced so quickly economically as happened in that era. Literally, each year, tens of millions of people joining the middle class. Today in China, over 250 million people now have extra disposable income. Never happened before in that country's history. We're familiar with what is happening in India and China. But you look at Central and Eastern Europe, that region as a whole had higher growth rates than the Asian region as a whole during that quarter of a century. The United States did very well. In the 20 years after the early 80s and the reforms we put in, the United States' share of the global GDP actually went up. Our share of global equity markets actually went up, even though we were the largest economy in the world. Between 2003 and the summer of 2007, when the economic crisis hit, the expansion of the U.S. in that 4.5-year period, just the growth alone, exceeded the entire size of the Chinese economy. We grew the equivalent of China in 4.5 years. Africa had 16 nations that by the middle part of this decade were achieving growth rates of 5 to 6%, and this was before the commodity boom of 2004. Got no publicity, but numerous countries in Africa were starting to move ahead. Same thing in Latin America. Countries such as Colombia were getting their acts together and starting to move ahead. So all of this just begs the question, what in the world happened? Why do we find ourselves in the mess, horrendous and discouraging mess today, where people are really wondering, where are we going? Well, this is truly a financial crisis. Financial crisis. In a modern economy, the financial system is essential. The flow of credit, banking, finance is essential for a modern economy. It's the equivalent of a heart of a body. You can be in great shape physically, you can have a great brain, but if your heart's in trouble, you are in trouble. And a year ago, when the financial system went in near cardiac arrest, that's why the U.S. economy went off a cliff in the latter part of last year and the early part of this year. So how did it happen? And how do we get ourselves out of it? Or are we getting ourselves out of it? Well, as we say today, thanks to that book and that movie, when a lot of things go wrong at once, we call it the perfect storm. First and foremost, in terms of what happened, biggest mistake was the Federal Reserve, monetary policy, interest rates. Now, I know there is no more boring subject than monetary policy. I can see the eyelids starting to get heavy already. It's been, the end of the day. Oh my God, are we going to have to sit through this? And just let me give you a travel tip. If you ever find yourself in coach, on an airplane, in a middle seat, on the runway, watching your life pass away, you want a little bit of elbow room? Talk to your seatmates about monetary policy. You'll have all the room you want. Or if any of you are single, or have kids or grandkids are single, on a date, you want out. Talk about monetary policy, and you'll never see that person again. Just guaranteed. Get rid of them. But if you think of it as you would an automobile, truck, whatever it is you drive, you can have a magnificent vehicle. But if you don't have sufficient fuel, you stall. You have too much fuel, you flood the engine. You have just the right amount, you have a chance to move ahead. Same is true of an economy. You can have basic strengths in an economy, but if you don't have sufficient money, credit creation, you're going to stall. If you create too much money, you're going to have problems, sort of the economic version of the flooding of the engine. If you have the right amount, you have a chance to move ahead. Long story short, in the early part of this decade, the Federal Reserve made a fateful miscalculation. It thought the U.S. economy was weak, that we were in for a decade of Japanese-like stagnation, such as Japan in the 1990s. And so therefore, even after the 2000-2001 recession, the Federal Reserve kept printing money, kept interest rates at an artificially low level. Now, when you print too much money, especially when the Federal Reserve prints too much money, because the dollar is the global currency, when you print too much money, the first area that feels it, first area where the money starts to flow is commodity markets. They're cash markets, denominated in dollars, global, they're the first that get hit. So normally commodities are all over the place. Some commodities are up, Some are down, some are treading water. When they all go in one direction, something is wrong. And in 2004, you remember, suddenly oil prices shot up, copper went up, lumber went up, corn went up, soybeans went up, silver went up, gold went up, heck, even the price of mud went up. Everything was going up. And people were wondering, what in the world is going on? Must be India and China. They're gobbling up all the world's resources. Or if you're a populist, you'll blame it on oil company executives. And so people didn't really look at the real source, the Federal Reserve. We went through the same thing in the 1970s. It was a classic commodity inflation. Now, when you keep printing too much money, it just doesn't stop with commodities. It flows into other parts of the economy. And in 2004, where did this excess liquidity go? It went into housing. Why? Housing was already booming in 2004 in this country as a result, in large part, of a tax law change we made in 1998. In 1998, we virtually exempted the capital gains tax from housing. If you owned your primary residence, you're a couple, you sold your house, your first $500,000 of gain was now free of capital gains taxes. And as you know, when you lower the tax on an asset, the value of the asset goes up. So if you look at housing prices in the United States pre-1998, post-1998, you'll notice a real difference. So by 2004, housing was already booming in the United States. Then comes this flood of money, and it just goes on steroids, just goes berserk. Classic bubble. Everyone figures housing only can go up. After all, for decades, housing always went up. Even if only nominally, it always went up. And people figured it's written in the Constitution. Housing prices must go up each year. It is your birthright. It goes up each year. So money floods in, lending standards go down, new players come in, and they invented a new mortgage. The new mortgage was, why have an income? Why bother? It's true. You know, as long as you are breathing, maybe even not, there's like voting in some places, just, you know. And so, no down payment, no principal payments, no interest payments. They called them negative amortization mortgages. Love the names they come up with this. And not documenting your income. You know, what's your income? Oh, $300,000. Oh, okay, sounds good. Verify it? Oh, heaven forbid. So they call them no-doc loans. It's amazing. So the thing just went berserk. And if you look today at foreclosures, if you look today at defaults, if people who've made down payments have much lower default rates than those who made no down payments. Huge difference. So housing goes on its merry way, and then you have Freddie and Fannie. Fannie Mae, Freddie Mac, implicit backing, they call them government-sponsored enterprises, implicit backing of the federal government, so they could borrow in a way that no private company could. And by early 2008, Freddie and Fannie together had guaranteed $1.6 trillion of suspect paper. So huge bubble. We've always had bubbles. Some of you may have read in your history book about the Dutch tulip bulb mania 3 centuries ago, where tulip bulbs were selling for the equivalent of $10,000, $20,000. Tulip bulbs are nice, but not $20,000 nice, but so these things have happened. But it took on to a scale that we've never seen before. When global economy gets wealthier, when a country gets wealthier, these things take on a dimension that they've never taken on before. And so, thanks to securitization, which in and of itself is a good thing, putting securities together, slicing them up and spreading the risk, that in a normal economy is a good thing, help lower mortgage rates in a normal economy. But also it meant this stuff went all over the world. And institutions didn't even know they had this stuff. You go home, look under your bed with the dust, you'll probably find a subprime mortgage floating around there. Just went everywhere. So 2006, things starts to leak. 2007, the bubble bursts. But even though there was a lot of bad paper out there, The financial system could have absorbed these losses, even with all these exotic instruments around, could have absorbed the losses, but other mistakes were made, particularly one huge one. If these further mistakes had not been made, the financial system would have taken huge losses, there would have been blood on the floor, but we could have absorbed the hits. The global economy could have absorbed the hits. But then another catastrophic mistake was made, another boring area, accounting. But it's amazing how these boring areas can have catastrophic consequences. In this case, the error had to do is how do you value the capital of banks and insurance companies, particularly life insurance companies, what they call regulatory capital. You know, financial institutions, many of you work for financial institutions, certainly Baltimore is home to some great financial institutions. The question, you always have reserves, especially if you're a bank and life insurance company, reserves for loan losses, reserves if you're an insurance company for future claims. And the question is, how do you value those assets for regulatory purposes? Not for accounting, GAAP, but for regulatory purposes. And traditionally, until 2007, the rule had been you value it at what you paid for it. So if you bought a $1,000 bond, 10-year maturity, for regulatory purposes, you kept it on your books at $1,000, unless you sold it or unless it became impaired, went bad. Otherwise, it was $1,000. Now, in 2007, they decided, that sounds boring. Let's force a change. Let's value this regulatory capital as if they're day trading accounts, like a mutual fund. That's dumb, to be blunt about it. Capital is supposed to be a ballast for a financial institution, supposed to provide stability, if anything, counter-cyclicality. But if you value it at market prices, why, in good times, you just goose the market even more. In bad times, you make a bad situation even worse because you're marking down the value of capital, whereas it should be the opposite. In good times, you should get tighter. Tough times, you loosen up to try to pull ourselves out of this slump, out of this nosedive. So they call it mark-to-market accounting. If you hear mark-to-market accounting, just in your mind go, boo, hiss, bad. And, we banned mark-to-market accounting in 1938 because it was deepening the Depression. But bad ideas, like monsters in movies, keep coming back, out of the lagoon, the swamp. Who knows where it came out of here? I could give you a history of it, but it's the equivalent. Mark-to-market's the equivalent of what would happen if you were told, sell your house in 3 hours. You'd say, that's stupid. You don't do that. But it'd be as if, okay, what price would you get if you had to sell your house in 3 hours? Well, that means you couldn't get a high price. That means you're broke. You say, well, I've got a job, I'm making the payments, what's your problem? Well, the value's down, therefore you're broke. So if you look at the losses of banks and life insurance companies, huge, hundreds of billions of dollars, the majority of those losses are not actual cash losses from bad paper. They're actually book losses, artificial losses. So we turned a bad situation into a catastrophe, sort of turning a flood, which is bad, into a tsunami. Gratuitously nearly destroyed our financial system. That's why TARP didn't work a year ago. They give the banks $300 billion to shore up their balance sheets. Very nice. But they effectively immobilized it by saying, okay, it's worthless. So, before Lehman, I hate to keep throwing numbers at you, but boy, this stuff is important. It certainly has impacted us. Before Lehman Brothers went broke in September of 2008, American banks had cash on hand of about $250 billion, had been for several years. This is for everything from ATMs, reserves, all their cash needs. Today, banks have on hand 3 times that amount, $800 billion. And yet, in the eyes of regulators, they're weaker than they were when they had $250 billion. This was insanity, and that's why the system nearly went into cardiac arrest. There are other mistakes were made. Rules on short selling were either not enforced or changed, so short sellers could just pound these stocks into oblivion. There was, as you know, in terms of rating agencies, why we do bond rating agencies different from, say, stock analysts. You know, when a company wants a bond rating, or any entity wants a bond rating, they pay the agency. Now, how much value would you put in a stock analysis of a company where the company paid the analyst to do the analysis of the stock? Okay. And moreover, credit rating agencies are in effect sanctioned by the SEC. You have to get permission to be a bond rating agency, which is nuts. I mean, I don't want to trivialize this, but you know, a lot of people rate colleges. U.S. News, Forbes does. A number of people rate colleges. We all use different criteria. So you, as the consumer, will judge which one you think is valuable for seeing who you think is good and who you don't think is good. Well, why not with rating agencies? Why have this cartel with the SEC? Just open it up. You decide what rating agency. Put responsibility back on you. Just can't say, oh, Moody says I'm good, or Moody says the bond was good. No, you got to make sure you do your fiduciary responsibility, make sure you really trust the criteria they use. So you put it all together. Then inconsistency. You know, Bear Stearns, spring of 2008, they rescue its operations. Come September, Lehman Brothers, far more important than Bear Stearns, especially for money market funds, they let that go broke. Why? Save one, let the other one go kaput. Then 48 hours later, oh, got to save AIG. Where's the strategy with that? Clearly, nobody knew what they were doing. So no wonder, just panic took over. Okay, where are we today? We've made some real progress. We in the world have made some real progress. First and foremost, mark-to-market accounting. It was finally amended, not because of the SEC or the Federal Reserve or the Treasury Department or the White House. This is going to come as a shock to you. It changed because of the U.S. Congress did something right. Now, I don't pick yourself up. It happens. It happens. They held hearings. They held hearings last March, announced it and then held hearings, brought in the SEC, brought in what they call the Financial Accounting Standards Board, FASB as they call it, brought them in and just beat their brains out. Not physically, but just verbally, just what they did to what they did to bank executives was comparison, was patty cake what they did to these people. Just smacked them around. And finally, one of the congressmen asked somebody from FASB, Financial Accounting Standards Board, said, "You're going to change this stupid rule in 2 weeks, right?" The guy from FASB said, "Well, you know, we'll consider it, blah, 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 blah." And the congressman said, "No, you're going to change it in 2 weeks." And the guy from FASB finally realized, if he's going to get out alive, he better make the promise. And he did, under duress. That's when the stock market turned. Markets anticipate the future. The markets turned sharply in early March. April, the rule was modified, not as much as I would have liked, but it was modified. Financial stocks took off like a rocket. Haven't reached anywhere near their highs of 2007, but way higher than the lows of March of this year. So the credit markets are starting to work. A lot of companies have issued stock. Even real estate investment trusts, which everyone thought were being priced as if they're going to literally all go out of business in March, were able to issue new stock, rebalance their balance sheets. Alcoa issued stock, and the stock went up because everyone knew they're going to use the proceeds to get their balance sheet back in shape. So a lot of progress on that has been made. However, the job is not yet complete, and that's why we have this uneasy situation in the economy today. Yes, there's signs of growth, signs of a comeback, but that should be no surprise. Given the severity of the fall that we took late last year and early this year, we should be snapping back. Even in the terrible decades of the 70s when we had a severe recession, you'd always get a snapback. Question is, would you sustain it? But at least you'd get a snapback. We haven't had a real one yet. Making progress, but it hasn't been as good as it should have been. Why? Principal reason, again, credit system, is while the credit system is working now for larger companies, it is not yet working for small businesses and consumers. Still very uneven in terms of credit availability for small businesses. For example, a lot of small businesses use credit cards, their corporate business credit cards, as a source of working capital. We all know what's happened to credit cards. Lines have been cut back, interest rates have been raised, and banks still being pounded by regulators. Even though mark-to-market was changed, regulators still haven't gotten the mentality right. They're still going to banks saying, shore up your balance sheets, tighten up your lending standards. That's very nice. You do that when times are good. When times are bad, you don't want them to be careless, but you want them to keep sound businesses and sound consumers going, so you don't make perfectly sound businesses unnecessarily insolvent. That's what you do, and they're doing just the exact opposite. So, and then you have the overhang of commercial real estate. Everyone knows commercial real estate. Prices have been knocked down. Loans are coming due in the next year or two. What's going to happen with them? You hear phrases like delay and pray, extend and pretend, and hope it works out. But this, again, gets, why isn't the rest of the credit system working? And so some of us found it very strange that this summer, Ben Bernanke and the Federal Reserve was patting themselves on the back for saving civilization. They only got the job half done. It'd be like saying, well, we've won the game, but it's only halftime, guys. You haven't finished it yet. So, bottom line on the credit system, how do we get it working again? Well, on the regulatory side, with the regulators, do the opposite of what they're doing. If a bank has any kind of adequate capital, tell them to lend. Don't cut back on sound borrowers. We did this 20 years ago when we had a credit crisis. You remember 700, 800 S&Ls went under. Banks were loaded with bad loans from Latin America, commercial real estate loans, and we got through it. We took some extraordinary steps, but we got through it. But very important, most basically important, if we want this credit system working the way it should. It'll sound simple, but it's absolutely basic, not only for us, but for the world. We must have a strong and stable dollar again. You cannot have weak money and a strong recovery. Weak money means a weak recovery. It's risky enough to make an investment, to invest in a business. But if you add to it the risk of what's the currency going to be worth, the tendency is less capital, more money for speculation in commodities and in currencies, and less in sound investments. The weak dollar's been poisoned for foreign investment coming into this country for purposes of plant and equipment and the like. It's a fraction of what it is, what it should be, and what it has been. So this is a crazy thing, a weak dollar. Now, why do we have a weak dollar? Government policy. That's the truth. It was the policy of the Bush administration to have a weak dollar. They'll never admit it, but the markets knew exactly their feelings on it. And this was the first administration, pains me to say it as a Republican, since Jimmy Carter's administration that had a weak dollar as a policy. When the Federal Reserve, for example, started to make mistakes, the Treasury Department, behind the scenes, should have said, cut it off, stop it. We're going to work together and turn this thing around. But the Treasury Department never did it. Why did they want a weak dollar? Because they thought it would improve the trade balance. Artificially lower the price of your exports, artificially increase the price of imports, and voila, the trade balance gets better. Put aside the stupidity of just looking at the trade balance alone in isolation from everything else. Just remember, in the 400 years in North America since the Jamestown settlement in 1607, we've had trade deficits for 350 out of those 400 years, and you can see the disaster that's ensued from it. I mean, you got to put it in perspective. But put that aside for a moment. Yes, the trade balance has improved, but look what you've done to the rest of your economy and the huge distortions that you've done in the flows of capital. And so this shouldn't be a partisan thing. I'm really surprised that the Obama administration's continued this weak dollar policy. I mean, John Kennedy, Democrat, said the dollar should be as good as gold. Ronald Reagan killed the great inflation of the 1970s. Bill Clinton, for crying out loud, whatever you think of him, got it right on the dollar. He knew politically that it was poison to have a weak dollar. He saw politically what it did to the Carter administration and was determined that was not going to happen on his watch, and it didn't. So, strong dollar. Can you do it? If the Federal Reserve announced tomorrow that they're not going to buy Treasury bonds anymore, government wants a deficit, fine, it's going to finance it without the printing press, you'd see gold go down $200 an ounce, you'd see the dollar soar in the foreign exchange markets. When you have a sound dollar, think of it this way. This is getting a little esoteric. Think of it this way. Money should be a stable measure of value, like minutes in an hour. Now imagine if our economic poobahs decided to improve productivity by extending the number of minutes in an hour. It's 60 minutes now, but by golly, if you increase it to 70 minutes, why, you'll get people working more at the same pay. They'll think they're still working an hour, and you're going to get more productivity. Boy, that's a way to get real economic. You say, nuts. Or you floated the clock, 60 minutes an hour one day, 80 the next, 20 the next, 90 the next. Right, soon you'd have to have hedges and derivatives and futures to figure out how many hours you're working each day. It's nuts. I mean, you just wonder what goes. Money as a tool of economic progress is crazy. It doesn't work. If that worked, Argentina and Zimbabwe would own the world. It just does not work. So, first and foremost, stabilize the dollar would go a long ways, and would also go a long ways to diffusing growing tensions around the world. Chinese, they have to buy our treasuries. They're highly upset. The Indians are actually going out and buying gold, which is a risky thing to do, but the central bank is doing it. They're saying, we don't trust your currency. So when that starts to happen, it hurts trade, it just fans protectionism, and hurts economic growth. And we've seen when global economies slow down, political repercussions are not very pleasant. So they tie together. So in addition to stabilizing the dollar, there are a number of other things that can be done. For example, trade. This administration should make a full commitment to free trade. If the U.S. doesn't take the lead on it, it won't happen. Ireland and Britain and France and Germany are not going to lead the charge for global free trade. The United States has to do it. It's been true since World War II. We have to do it. Otherwise, protectionist tendencies are just going to grow and grow and grow. We should know from the 30s where that can lead. Not a good thing. So in terms of big things, dollar and trade, there are a lot of things we could do here at home, which I think would also be a good thing for around the world. There are 5 basic principles of economic progress. One is the rule of law, another boring subject. But think of it, if you don't have equality before the law, how can an entrepreneur challenge the existing power structure? Nothing there to protect him. We've seen countries like Russia, what happens when you don't have that kind of basic protection, which also encompasses property rights we take for granted in this country. You buy a piece of property here, you can use a bank in London, Japan, all around the world. Everyone recognizes you own that piece of property. Many countries don't have a property system, and it just immobilizes capital. Just to give you an example, several years ago, Egypt asked a group of economists headed by a Peruvian to do a survey in their country of who owns the businesses and who owns the housing in Egypt. So they did the survey, came back to the President, Mubarak, and said, Mr. President, 88% of your businesses are illegal. Well, no surprise when you have to go through 15 different licenses fees of all sorts, and you know what else of all sorts to be legal. Most people don't. You look at countries with big informal economies, many cases it's because it's impossible for a normal person to get a license. Here we take it for granted. Easy to set up a business, doesn't mean you're going to succeed, but it's routine. Now, then they told them about housing. 92% of your housing is illegal. Nobody gets permits, same reason. They said even your public housing is illegal. He said, what do you mean? We built it. They showed him pictures. Here's Nasser City, Mr. President. You put in structures at 4 stories. Look at them now, 6 stories, 8 stories. People just built on top of them. And they found out in Egypt there are about 8 or 10 different property systems. So guess what when you have that kind of a chaos? No mortgage market, or very short-term and very expensive. So as a result, remember, we know, yes, that can be done to excess, but physical structures can also be sources of capital. In this country, until the financial crisis, you know what was the biggest source of money for new businesses? Mortgages. Not Wall Street, not venture capitalists. People increasing their mortgage, taking a second mortgage, home equity loan. Huge source of capital. It's not just a place to live. It's also turning physical structures into liquidity. And Hernando de Soto, a Peruvian who studied this thing, figured that 4 billion people around the world own property worth $9 trillion that's dead capital because you don't have the kind of property systems we take for granted here and in the West. Japan, after World War II, had an antiquated property system. The farmers there, the peasants, the small farmers there, had an informal system on exchanging and buying property, but it was not recognized in law, and a huge drain. Well, one of the good things we did in the post-war occupation in Japan was we took this informal system and, in essence, made it the legal system, broke up the old feudal system. And that was a key reason, not mentioned in history books, for Japan's post-war boom, was a modernized property system. So boring thing. Another one, sound and stable money. We know about that. Another one, sensible tax system. We all think of taxes raising revenue for governments. They're hungry for it these days. But remember, taxes are a price and a burden. The tax you pay on your income is the price you pay for working. Tax on profits, price you pay for success. Tax on capital gains, the price you pay for taking risks that work out. And what political structures have a hard time understanding is if you lower the price of good things like productive work, risk-taking success, you will get more of them. Fourth basic principle relates to the rule of law. Make it easy for entry into a business. And final one, trade. Remove trade barriers, not just across borders, but internally. This country has its share of abuse of licensing procedures. It's one thing to license physicians, we can see that, but for braiding hair, well, that's just a barrier to entry. So you want to remove those barriers, make it easy for people to take risks and do business. 5 basic principles: rule of law, sound money, sensible tax structure, ease of entry into starting a business, removing barriers to business. Sounds simple, but it's amazing how often those basic principles are violated. So where does this leave us today? Where does this leave the world today? Right now, things are starting to show bits of signs of life. We got to make a few changes to get this thing really going. No one wants a redescent to the purgatory of the 1930s. But tensions aren't good enough. So how do we dig ourselves out of this hole? Then we'll get to a Q&A. Right now, the situation, if you look at the numbers, looks hopeless. Huge deficits, biggest since World War II. Never in peacetime have we run deficits of this magnitude. National debt's going to triple in the next 10 years. Triple. Debt held by the public from $7 trillion to $21 trillion. Unfunded liabilities of Social Security, $10 trillion. Unfunded liabilities of Medicare and Medicaid, $40 to $60 trillion, depending on your estimates. This is just hopeless. So how do we dig ourselves out? The way we did it 30 years ago, after the 70s, when you could have made a case things were as hopeless. That is, you look at the balance sheet of the nation. Liabilities, we all know what they are, potentially. Key thing is grow the assets. Not just grow the economy, but when you have a vigorous economy, assets increase in price. Think of it this way. If you look at the assets of the American people, American households, what we own in stuff, in houses, cars, furniture, our financial assets, then subtract out all we owe, credit cards, mortgages, debts of all sorts. Even in this terrible time, American households, according to the Federal Reserve, have net assets of $53 trillion. Now, it's down from the high of what it was a couple of years ago, but still, $53 trillion is good stuff. And if you look at the gross assets of the American people, it's almost $70 trillion. So think of it this way. If you just have a 10%, 15% increase in the assets, which isn't hard to do after the fall we've taken, that's $10 trillion. That overwhelms the stupidity coming out, financial fiscal stupidity coming out of Washington. That's what we did in the 80s. In the 80s, even though Ronald Reagan spent to win the Cold War, it worked. Congress, as usual, continued to spend here at home. And so the national debt went up $1.7 trillion in the 80s. But what was happening? If you looked at just that number, you'd say, oh my God, after a terrible 70s, the world's come to an end. Yet in the 80s, the U.S. was the most vigorous economy in the world again. Silicon Valley was coming into its own. Economy was growing. But so was the value of the assets of the nation because people saw a future again. And so if you think there's a future, suddenly an asset becomes more valuable. At the end of the decade, even though, again, I apologize for using these numbers, but while the national debt went up $1.7 trillion, the net wealth of the nation, assets minus liabilities, went up $17 trillion. That's how we got out of the hole of the 1970s. And that's the only way we get out of the hole today, is growth, innovation, assets go up, and suddenly we can breathe again. Think of it this way. If Bill Gates goes out and borrows $1 million, big deal. He's worth $58 billion. But if somebody working at, say, McDonald's and minimum wage borrows $1 million, okay, there's a problem here. It's not just liabilities, it's the assets. Grow the assets of the nation, then suddenly the debts become tolerable. The liabilities become something we can cope with because we have the wealth to do it. So, quickly, how do we do it on health care? How do we do it on Social Security? On Social Security, forget my generation. We're hopeless. We mucked it up in terms of financing. Get over it. But for younger people, why not for younger people? When we have the wealth to pay our benefits, forget the fiction of the trust fund. There's wealth in the nation to pay those benefits. But for younger people, hopeless. So why not put in a new system for younger people where their taxes go into their own personal accounts, proper regulations, proper diversification. Suddenly, a liability becomes an asset. The money's invested. The economy over the years becomes stronger. And you'll get more in retirement as a younger person than you will with the crazy system we have now. Why politicians thought you could have a pension system without accumulating reserves over the years? Only they could do that. But we did it. Okay, let's make sure we don't make that mistake again. Can it work? Galveston, Texas. Galveston, Texas. In Galveston, Texas, 3 counties pulled out of Social Security in the early 80s. Government workers. You're allowed to do so in those days. What did they do with the money? They didn't even put it in the stock market. They just put it in CDs, treasuries, interest-guaranteed contracts from sound insurers. So taking minimal risk, you know what their benefits are today? People now retiring 50 to 200% higher than they would have if they'd stayed with Social Security. Somebody making as little as $17,000 a year with Social Security, you get about $680 a month. Galveston, you're getting $1,200 a month. So, yes, it can work properly done. Take the hit now, get a new system in for younger people, liability, asset. Same thing on health care. Just ask yourself, why do we have a health care crisis? Well, people say we want more health care. Can't afford it. Well, why? If people want more software, Silicon Valley will find a way to write it. If people want more cars, Detroit would be very happy and find a way to produce them. The whole essence of free enterprise is if people want more of something, entrepreneurs are going to figure out how to provide it and provide it more and more cheaply. The difference in healthcare is the crazy way we finance it. It's all third party. So you, the consumer, you don't matter. Think of it. If you go to a doctor, clinic, or hospital, and you ask the price of what it costs, why, you're either crazy or you're uninsured. Why else would you want to know what it costs? What does it matter to you? Think of it. Everything else you do, you want something. You think, what's it going to cost? What am I getting for it? Yet in healthcare, why would you want to know what it costs? So the system is skewed. We have part free enterprise, part hybrid, part government. It's a crazy system. So can we get free enterprise in? People say, well, we need to ration health care because everyone wants more of it. Why isn't that the greatest growth opportunity around? People figuring out, how do we provide you with more health care at a more affordable cost? Can it be done? LASIK surgery for the eyes, millions have done it, so maybe you don't have to wear these things. Basic surgery, conventional surgery, costs a third less in real terms today than it did 10 years ago. Why? Because you write the check, so providers have every incentive to make it more affordable and attractive to you. They've made great advances on it, and it hasn't skewed the way the rest of healthcare has. Another example, cosmetic surgery. None of you need it. It's called pandering, you know. Tried it in politics, didn't work, but, you know, it's why I'm here, not in the other town. But you know, cosmetic surgery in this country has grown sixfold in the last 15 years. Huge technological advances. And yet you haven't had the kind of inflation there that you've had elsewhere. Why? Because unless it's a result of accident or disease, you are the consumer. So if you want something done, you scope it out. What's it going to cost? Who might be good at it? If you have friends who keep their mouths shut, you might ask them about it. And so the system works. Can we get that in the rest of healthcare? We can certainly make progress to it. So instead of having the government do more and more, which doesn't work in terms of innovation, in terms of creating lots more health care and more affordable costs, well, let's start by health insurance. Let's have the interstate commerce clause, so you can buy health insurance in any part of the country you wish. You know, think of it. Think of it. You live here in Maryland. You want to buy a policy in the district or in Virginia or New York or California. It's illegal. Yet you can buy a car in Virginia. You can open a bank account in Virginia, trade stocks in Virginia. Yet it's illegal to buy insurance in Virginia. I live in New Jersey, and we do a lot of crazy things. So in health insurance, a policy that would cost me $15,000 in New Jersey, I can buy in Pennsylvania for $7,000, Wisconsin for $5,000. Why can't I be allowed to do that? You then get real competition, literally hundreds of companies figuring out how to provide it in a more affordable way for you. And if you have a condition, somebody will figure out, okay, how do I do it a way that makes it attractive to you? And then on taxes, if you're a business, you get a tax deduction. Okay, if they get it, why not you? So you get a tax credit, get a tax deduction. And so if you don't like what your employer offers, why do you have to take it? Why can't you then go out in the market and say, well, I don't like what my employer offers. I want to shop for something that I need, not what my employer thinks I need. It's called choice, free enterprise. Tort reform, allowing small companies to band together to buy insurance if they wish through associations. Basic stuff like that. And you'll start to see the system become more responsive, more productive, more innovative in ways that we can't even imagine today. And it can be done. People say, well, healthcare is different. Well, every service and product is different. What's more basic than health care? Food. No food, no health. Do we have a food crisis in this country? The only food crisis is some of us eat too much of it. And we grow too much of it. But if people can't get food, we have mechanisms in place, like food stamps, to make sure if something happens, you're going to get food. Why can't we do the same thing in health care? Have free enterprise run free? And if people, for whatever reason, can't get it, well, then you can deal with specific cases to deal with it in a way where you're not just hoping something good happens by throwing something out there, but you can focus specifically. Why are certain people not getting it? What can we do to make sure they get access to it? It can work. So bottom line, yes, we face a crisis today. It's not just economics. It is our political future as well, the world's future as well. But while we help make this situation come to what it is, there's no reason why, with a little imagination, as we did after World War II. They call World War II generation the greatest generation. Yeah, we won the war, but we won World War I. And then we blew it in post-World War I. Post-World War II, we largely got it right with things like GATT, removing trade barriers, sensible monetary system, security like NATO, and other positive things. So we won the peace, turned Germany and Japan, hideous totalitarian nations, into viable democracies. And then post-Berlin Wall, for all the mistakes made, you saw vibrant economies in Central and Eastern Europe, finally. Things were starting to move. And if we just get over this temporary, which should be a temporary situation, no reason why we can't get it back on track and win the post-Cold War the way we won post-World War II. Thank you.
I was going to say that every generous instinct I had toward you would extend the period, but the 70-minute hour, which you suggested, can't be created. This was truly a comprehensive and thoroughly enjoyable presentation. We thank him again.